All right, welcome to Laguna Capital segment on interest, the basics. Interest is a very important financial concept that you should know and learn. This is important in loans and finances. The interest rate is the amount that a lender is charging you for you to use their assets, typically represented by a percentage of the principal. There are two types: annual percentage rates, or APRs, which are the most common, and annual percentage yields, APYs, common at financial institutions with saving accounts and CDs. There are two types of interest accumulations, and those are simple interest and typically used as a simple interest, and compounding interest rates that vary on your borrower's credit score. And that is why credit is so important. And they get you the best loan rate that's available. So, how interest rates are determined. The state of the economy is one way, the central bank is another way. The government sets the higher cost of debt. Rates will rise. Lower rates when the economy is in hardships, and rates determined on inflation. Rate examples. Your fixed interest rate, which is your most common example in traditional loans. You can lock in 1 year at 3%, but then rates rise and go up to 8%. Well, guess what? You just saved 5% compared to others, and the opposite can exist. This is why a fixed interest rate could be amazing or could be a downfall. Next, there's floating interest rates, or known as variable interest rates, a rate that changes based on the period. Most credit card companies and ARMs used when you buy a mortgage use this. So here's an example. If you can lock in a 3% 1 year over the next 10 years, then you're good. Or if you use a float interest rate, or floating interest, or a variable interest rate, you lock in 3% for the first year, but then all of a sudden depression happens and rates change dramatically, or the state of the economy increases, whatever it is, then all of a sudden now your 3% that you thought will be increasing and you're stuck paying 10%. So hopefully you understand both of those. A fixed interest rate is a set interest rate that no matter what happens, it's not changing and moving. Could be great, or it could be horrible. If you lock in a 10% and rates drop to 4%, you're out of luck. And the floating interest rate, if the economy is just going to be stagnant for a while, maybe that's the best way to go. You're floating with the economy. It might increase 1%, it may decrease 1%, or it can increase a whole lot more, or it could increase a whole lot less. So, just some things to keep in mind. There's simple interest. The most common and easiest to understand is your simple interest rates. This is just simple interest, which is the principal multiplied by the interest rate multiplied by the time, or the unit of measurement. So, what do I mean by this? Well, let's give an example. So, if you were to buy $1 million house, your institution charges a APY for 1 year at 10%, or 0.1 in this situation. 1 million times 10% is $100,000 is owed in interest. That's your simple interest. So, at the end of the year, or the time frame of 365 days in this context, which is 1 year, is used, and that is the unit of measurement in this case. So, plugging it back into the equation, we'll have 1 million multiplied by 10% multiplied by the length of time of 1 year, which in return gives you your simple interest rate of $100,000. At the end of the year, you will owe the institution $1.1 million. Now we're going to move into what compounding interest is. So, what Laguna I Capital calls as being tricked, or interest on interest. This process is when you compound your interest, or you owe interest on the principal, as well as more grows on your interest on the past period. So this usually works with credit cards, where they like to get you on more and more and more. So the calculation would be your compounding interest equals your principal multiplied by, in parentheses, 1 plus your interest rate to the n power, or the number of compounding periods, all subtracted by 1 and multiplied by that principal after doing the equation. So here's an example. Say we're going to use the same example as we did last time with the $1 million house at a 10%. So now we're moving on to a 2 or a 3 or 4 year loan, but we're in this situation, we're going to do a 2-year loan. So year 1 is $1.1 million. Now you're compounding for year 2. So your 1.1 million multiplied by 10% equals the interest on year 2, which will be $110,000. Now in year 2, you now owe $1.21 million instead of $1.2 million if we were going off of the simple interest method. Credit cards love to do this because it's more money on money for them to make more money from you. And it's horrible, but it is the situation. So hopefully now that you can understand interest and compounding interest examples and simple interest examples, always keep your eye open for compounding examples or compounding interest, because as you just learned, you may owe another $10,000 on an investment that, if you just had a simple rate, would have saved you that $10,000. So always remember, the ones that are out to get you, in our opinion, are the ones using the compounding example. And the ones that are just out to charge you because, yes, they get to reap the benefits as well, would be the simple interest rates as well. So thank you very much, and I hope that you've enjoyed this lecture on interest.